A single night in the ICU at Bumrungrad International Hospital costs between 25,000 and 80,000 baht. Not the surgery, not the anesthesiologist, not the specialist fees, just the room. A 5-day cardiac admission with intervention can total 400,000 to 1.2 million baht. And yet tens of thousands of expats living in Bangkok right now are either self-insuring or holding a plan they've never read carefully enough to know what it actually covers. That is the number that should reframe this entire conversation. Because the question in 2026 is not whether you need health insurance in Thailand. That question answered itself. The real question is which of the 5 major insurers is currently the least bad deal for your age, your claim history, and your visa situation. And that answer is completely different for a 34-year-old digital nomad than it is for a 62-year-old retiree on an OA visa. This video breaks down the 5 dominant insurers operating in Thailand right now, the premium trajectory driving decisions in 2026, and the one switching trap that is costing expats real money. Let's get into it. Here is what changed between 2024 and now. Thai private hospital billing rates rose by an average of 12 to 18% over the past 2 years. Not your premium, the underlying cost of the care itself. Every insurer operating in Thailand absorbed that billing inflation and is now repricing accordingly. A 35-year-old expat who bought a BUPA Thailand IPD-only plan 3 years ago for 18,000 baht a year is now looking at 26,000 to 32,000 baht at renewal. Thailand's official CPI inflation in 2024 was just 1.37%. This is not general inflation. This is a deliberate repricing event driven specifically by private hospital billing. And it is not going to reverse. If you renewed recently and your broker told you the increase was a small adjustment, that framing is technically accurate and practically misleading. The premium trajectory you are now on compounds every year you age into the policy. Understanding why it's happening and which insurer is managing that trajectory least aggressively is worth real money over a 5-year horizon. Let's quantify it. If your current premium is 30,000 baht a year and it rises by 10,000 baht per year for the next 5 years, that's 50,000 baht in cumulative overpayment versus a competitor plan with better cost containment. That is not a hypothetical. That is the math of staying with the wrong insurer because switching feels complicated. Let's set the context. Thailand runs a 2-tier medical system. On one side, genuinely world-class private hospitals. Bumrungrad, Bangkok Hospital Group, Summitive, Paulo, used by virtually every English-speaking expat in the country. On the other, an underfunded public system that is technically free, but almost no expat actually uses for serious care, for reasons that range from language barriers to wait times to diagnostic equipment availability at public facilities outside Bangkok. As a foreigner in Thailand, you are ineligible for Thailand's public health schemes. The Social Security Fund and the Universal Coverage Scheme are both restricted to Thai nationals and registered Thai employees. You are not in that system. You pay out of pocket or you hold private insurance. Those are your 2 options. The 5 insurers that dominate the expat market each operate differently. BUPA Thailand and AXA Thailand are licensed under the Thai OIC, the Office of Insurance Commission, which means disputes are resolved under Thai law in Thailand. LMG Insurance is also OIC regulated, and all claims disputes fall exclusively under Thai jurisdiction. That matters more than most brokers will tell you, because any dispute is conducted in Thai language and typically takes 3 to 12 months to resolve. Cigna and Pacific Cross, by contrast, offer internationally structured policies with international dispute resolution mechanisms. That structural difference is rarely visible in a broker comparison spreadsheet. But it is exactly the kind of detail that matters the moment you have a disputed claim for 400,000 baht. Now let's walk through how the major plans actually compare in 2026. For a non-smoking 35-year-old male, here is the rough premium landscape. LMG Super Care Basic IPD plans run 12 to 20,000 baht per year, consistently the cheapest in the Thai licensed market. BUPA Health Plus entry level sits at 15 to 25,000. Pacific Cross Essential, Thailand only, IPD plus OPD runs 22 to 30,000. AXA Smart Care comes in around 28 to 38,000. And Pacific Cross Elite with regional Asia coverage reaches 38 to 52,000 per year. The cheapest option looks attractive until you read the sublimits. BUPA's entry-tier policies carry a room and board sublimit of just 3,000 to 4,500 baht per night. A standard private room at Bumrungrad International starts at 6,000 to 9,000 baht per night. The arithmetic is uncomfortable. Even with what you believe is full insurance coverage, you could be paying a daily out-of-pocket top-up of 2,000 to 5,500 baht every single night of a hospital admission. Budget tier plans are not cheap. They're plans where you absorb a portion of every bill and don't realize it until you're already admitted. The regional coverage question is worth pausing on too. Pacific Cross Elite charges roughly 60 to 75% more than the Thailand-only Essential plan. That premium surcharge only makes financial sense if you are regularly seeking medical care outside Thailand, at least once every 2 to 3 years. And the country you're seeking it in is not excluded under your area of cover clause. For most expats who live in Thailand full-time and travel regionally for leisure, the Thailand-only plan almost always wins on cost per benefit. Here is the mechanism that most expats discover too late. Picture a 47-year-old who has been on a Pacific Cross Essential plan for 4 years in Chiang Mai. Premium started at 28,000 baht. Now at 41,000. The broker quotes AXA Smart Care at 36,000. Better OPD coverage, 5,000 baht cheaper. Sounds like a straightforward win. What nobody said clearly, switching insurers at 47 triggers a full new underwriting assessment. That back issue treated 2 years ago, previously grandfathered under your existing policy because you held continuous coverage, is now a named pre-existing exclusion on the new policy. You are not saving 5,000 baht. You are potentially creating a coverage gap that could cost you 200,000 baht or more if that back condition deteriorates into surgery. Switching health insurers in Thailand is not like switching phone plans. Every year you age, the new underwriting assessment gets more consequential. Every condition you've been treated for becomes a potential named exclusion. The older you are, the more medical history you have, and the harder it is to switch without accepting meaningful coverage gaps. The expats who pay the least over a decade are usually the ones who chose the right insurer early and stayed, not the ones who optimized for this year's premium. The visa compliance dimension adds another layer. If you're on a non-OA visa, Thai immigration requires you to hold a policy with a minimum of 40,000 baht inpatient coverage and 10,000 baht outpatient. But most decent plans exceed that floor. The DTV visa currently has no mandatory insurance floor. But that regulatory picture can change, and being uninsured or underinsured at the point a requirement is introduced creates a renewal problem on top of a health problem. So what does this mean practically, right now? If you are currently insured and considering a switch for the first time, get your existing policy's pre-existing condition portability clause in writing before you do anything else. That clause tells you which of your current conditions would transfer to a new insurer and which wouldn't. If you have any treated condition in the past 3 to 5 years, assume it will be excluded on the new policy unless you have written confirmation otherwise. If you are new to Thailand and choosing a plan for the first time, the smartest thing a 35 to 45-year-old healthy expat can do is choose a plan 1 tier above the minimum they think they need. specifically to secure the higher room and board limit and the international dispute jurisdiction, and lock in while they are still clean underwriting history. The cost of being one tier too low shows up not in the premium, but in the bill. If you are over 55 and already insured, stay where you are unless the coverage gaps in your current policy are documented and material. The switching cost at that age, in terms of underwriting exposure, is almost never worth the premium saving a broker is quoting you. One thing to take from this: the headline premium is not the cost of your health insurance in Thailand. The real cost is the premium plus the sub-limit exposure on every admission, plus the underwriting risk you accept every time you switch. Run all three numbers, not just the first one. For a deeper breakdown of how each insurer handles pre-existing condition portability, how OIC jurisdiction affects claims disputes in practice, and how health insurance interacts with Thailand's income tax rules for long-stay expats, subscribe to the Bangkok Brief newsletter at thebangkokbrief.com. And subscribe to this channel so you don't miss the next one.